this week's market update. Investors run scared of Italian political turmoil, doubts rise about the pace of US monetary tightening, MSCI includes Chinese A shares in its indices, and the FTSE reshuffle changes the face of the UK's stock market benchmark. Investors came back from a hot and stormy Whitsun bank holiday weekend to face hot and stormy conditions in European stock markets. The trigger has been a deepening crisis in Italian politics, which on Tuesday sent shares sharply lower and bond yields sharply higher. Italy has been struggling for more than 80 days to put together a workable coalition government since the spring general election, which saw two anti-establishment, anti-EU parties riding a wave of popular discontent. The Five Star and League parties were always unlikely partners in that coalition, but in the end their attempts to form a government were stymied not by internal disagreements, but by the country's president, Sergio Mattarella. He dealt a death blow to the latest attempt to create a government by blocking the appointment of an openly anti-EU finance minister, Paolo Savona. The president has the power to block cabinet appointments, and he said Mr. Savona posed a threat to Italy's place in the Eurozone. The president has asked Carlo Cottarelli, a former IMF official, to form a caretaker government. He replaces Giuseppe Conte, who had been Five Star and the League's preferred prime minister, but whose tenure as PM has been vanishingly short, even by the standards of Italy's spinning political doors. So, why does this matter to investors? Well, it matters because Italy is the Eurozone's third largest economy, and now it looks almost certain to be heading to another general election in the autumn, or even sooner, which could well deliver an even stronger anti-EU mandate. That's because the next election will most likely be pitched as a vote on democracy and self-determination in Italy, with anger rising about the influence of Brussels and the financial markets on the country's domestic politics. For many, President Mattarella's intervention is simply undemocratic. The Five Star and League parties amassed more than 55% of the vote at the last election and could well do much better at a rerun of the poll. Both have proposed big tax cuts and spending plans, worrying developments in a country that already suffers from high debt levels and an underperforming economy. The market reaction to that prospect has been dramatic. The bond market has borne the brunt of investors' anxiety, with the yield on the two-year bond rising to its highest level in more than 4 years. This morning it was 2.57%, but it went as high as 2.73% yesterday, up nearly 2 percentage points from Monday's close. The 10-year bond yield hit 3.39%. That was up 0.7 percentage points from the previous close, and it's currently 3.16%. Bond yields, of course, move in the opposite direction to prices. The gap in yield between Italian bonds and safer German bonds is now more than 3 percentage points, as investors demand a bigger income to compensate them for the risk that they will not be repaid their money at the bond's maturity. Italian stocks also fell sharply, with the MIB index down 3% on Tuesday, as Ignazio Visco, the governor of the Bank of Italy, warned that the country was, in his words, a few short steps away from losing the asset of trust. Italian shares have now fallen 7% in a week, and they're down for the year to date, having been the best performing European market until the latest crisis blew up. The fallout from Italy's political crisis is also starting to be felt outside the country's borders. In the bond market, the 10-year Portuguese bond yield is up 31 basis points, 0.3%, while Spain's equivalent is up 14 basis points. Not helped by a likely vote of no confidence in Mariano Rajoy's minority government, which is mired in scandal. The Madrid stock market fell more than 2% yesterday, while London's market was 1.3% down. Later in the day, the bad news spilled over into the US trading session, which was also spooked by fears that the US-China trade war was intensifying. Overnight, many Asian markets were sharply down on the cocktail of bad European and bad trade news. In the currency market, the euro slipped nearly 1% to trade below $1.16 for the first time since last November, as investors worry about the future of the Eurozone. So Italy is the main market story this week, but it's not the only one. On Friday, the non-farm payroll data will once again focus attention on the Federal Reserve's monetary tightening plans, with doubts being raised about whether the Fed can keep up the pace of rate hikes it's proposed. Minutes of the last Federal Reserve meeting suggested rate setters in Washington are pretty evenly split between those expecting a total of 4 rate hikes this year and those wanting to see only 3. A weak employment report on Friday would probably tip the balance towards a more cautious approach. The minutes were notable for their reference to a symmetric inflation target. This suggests that the Fed may be willing to tolerate a slightly higher inflation rate as much as a slightly lower one. In other words, the US central bank may well prefer to let the US economy run a bit hot than risk snuffing out recovery too early. Lower for longer rates would in turn probably be reflected in less upward pressure on the dollar, which markets around the world would most likely welcome. A strong dollar is seen as a negative for big US companies, which become less competitive in global export markets. It's also fueled nervousness in emerging markets, where the rising cost of servicing dollar-denominated borrowings is a concern. Another key market story this week is oil, where the rise above $80 a barrel in the cost of crude has reignited fears about a slowdown in economic activity. The US, of course, triggered the rise in the oil price with a hardline approach to Iran, which threatened to take a key source of oil production out of the global market. Since then, the US has been twisting the arm of its main Middle Eastern ally, Saudi Arabia, to keep a lid on the oil price by increasing production. Saudi Arabia is in a strong position to do that because it's reined in output alongside its OPEC peers and Russia for the past 18 months or so. The latest speculation is that the decision will be ratified next month to increase production by 1 million barrels a day. Markets responded by reducing the price of Brent crude to about $76 a barrel. At home, the big market story will be the latest reshuffle of the main FTSE market indices. Hitting the headlines will be Ocado, which looks likely to enter the top flight of Britain's biggest quoted companies after its share price trebled over the past 6 months on the back of a deal to license its software to US online retailers. Marks & Spencer looks like hanging on to its FTSE 100 status by the skin of its teeth, but other retailers are set to be given the boot from the broader FTSE All-Share Index. Carpetright, Mothercare and Moss Bros all look likely to leave the index, which is tracked by a large number of passive funds, of course. G4S looks like being the FTSE 100 company that has to make way for Ocado. The FTSE 100 has been around since 1984 and has seen many changes along the way. Even if M&S survives the cut, there will only be 28 of the original 100 companies that formed the index 34 years ago. Meanwhile, on the other side of the world, another key change in stock market indices will take place on Friday when MSCI, the New York-based stock index compiler, includes Chinese A-shares in its emerging market benchmark for the first time. Around 240 Shanghai-listed shares will join the MSCI emerging market index, although to start with, they will have a much reduced influence on the level of the benchmark because MSCI will only use 2.5% of the company's market capitalization in its calculations. The inclusion of Chinese shares is nevertheless a significant moment for global stock market investors, because the Shanghai market, with around 4,000 stocks, is too big to ignore. Many of the companies listed there are pretty much unknown to investors outside China, but as barriers have progressively broken down, they're bound to become much more familiar. China's A-share market is generally cheaper than those in nearby markets such as Hong Kong, and much more volatile as retail investors play a much bigger role than they do in more institutionalized markets like ours in London. That creates opportunities for overseas investors as prices can bounce around for no good reason, but it also makes investing in domestic Chinese stocks more risky. On the corporate front, things are rather quieter this week, with the first quarter earnings season largely done and dusted. But it would be a strange week this year that did not include at least one retail sector profits warning. This time it's come from Dixon's Carphone, which lost 27% of its value yesterday after its new chief executive, Alex Baldock, warned that there was, quote, plenty to fix at the company. He said that full-year profits for the year to April would be around a quarter lower than the previous year and will drop another 20% in the year ahead. Dixons Carphone may be struggling, but the manufacturer of one of its key products, Apple, continues its relentless drive towards becoming the world's first trillion-dollar company. At $927 billion, Apple's market cap is safely above its tech sector rivals. Amazon weighs in at $781 billion, with Microsoft and Alphabet lagging at $756 and $750 billion respectively.